So Realty Income just reported earnings, and I just wanted to follow up on my latest video talking about the interest rate environment and understanding exactly what's going on with the REITs because they've definitely been an underperformer. When we look at Realty Income Corporation, ticker symbol O, this is a very reliable monthly paying dividend that I think a lot of dividend investors rely on. The stock was over a $70 stock, now trading around $50 to $55 a share. And my biggest concern with the REITs is that they look cheap, but are they really safe in the interest rate environment? And so there's nothing fundamentally wrong with this company, but I do think valuations are going to stay compressed, and we're going to go over the earnings right now. By the way, if you like this fundamental approach, make sure you like and subscribe, hit that bell. So we're going to go over a lot of different things in this video, including the interest rate environment that total revenues did increase, but the thing I really want to point out here is the efficiency of last year versus this year. They did $944 million in revenue same quarter last year while doing $1.26 billion in this quarter. But when we look at it from a net income per share, it was definitely more efficient in 2023. And when we bring it down to funds from operations, we can see here that they were more efficient last year in the same quarter, and not a huge difference from a normalized funds from operation as well. So when we're looking at the REITs, we really want to focus in on funds from operations. This is basically how we understand the valuation of our REITs that we're buying. When we look at the AFFO per share, what that's going to incorporate is adding back in rent increases, but taking out capital expenditures and maintenance on properties. But overall, I would say that this is, even though revenue grew, the true fundamentals in the company are actually remaining fairly flat. Hence why there hasn't been a big move in the stock price after hours. To me, I'm looking at this earnings and I'm just saying, it's about flat from last year. And so there doesn't really need to be any sort of valuation increases or decreases here. I can see it probably trading still in the same range between $55 to call it $60 a share pretty consistently here. I don't see any reason why it wouldn't. But if we're thinking more forward looking here, what are some things we really need to be considering? So we can see here that they have right around 217 properties coming off a lease, which is really not going to impact this company because I believe there's over 15,000 properties. So with 217 properties coming off a lease, we can see here that is a very, very small percentage to the 15,480 properties that they have, less than 2%. So a few things we need to look at here. Some properties are coming off a lease, which is pretty normal, but the question becomes, because of the environment that we're in the question about commercial real estate, is this going to be an issue for them having leases re-signed here? And that's just something to keep in the back of your mind, as well as the company is basically staying flat from an earnings perspective, but it's taking on more debt. So there's a little bit more liability here when we look at the leverage from the company. Now, that's not the biggest problem. Actually, the biggest concern that I have with the company is going to be the interest rate environment that we're really going into. I just want to brush through in January kind of the notes that they're putting out there. So they had $450 million of notes that they issued for 4.75, for $800 million for 5.125. So we're starting to see these notes that they're issuing reach over 5%. And you're thinking to yourself, well, yeah, we're in a higher interest rate environment. And that is true. But what I want you to pay attention to is the debt that's coming through over the next few years is basically increasing their exposure by 10 to 15% on their expenses, because we can see here that in 2024, they have almost $2 billion due at 4.4%, and then a variable rate due for $764 million at 4.3%. And then in 2025, there's 4.2%. 2026, 4.1%. So now when we think about the interest rate environment that we're currently in, where we're looking at 5%, maybe over 5%, this is really going to impact that FFO that we were talking about earlier. So I want you just to keep all this in the back of your mind when we're thinking about this being such a stable company, such a safe company. And yes, it has been. But I also want to reiterate that we're seeing interest rate levels at 20-year highs, and we're in an unknown environment when it comes to commercial real estate. So are they going to be able to re-up those leases? Are they going to have to lower prices to entice people to get back into commercial real estate? On top of that, are they going to be dealing with higher costs on their debt? So it could burn the wick at both ends here. And I'm not trying to scare anybody. I'm just trying to bring attention to what could be going on here. When you think you're buying a safe company, you have to understand what is going on behind the scenes here. So I kind of want to leave it there for just a minute here and talk about their guidance. Now, net income per share is going up slightly, which is nice to see. But as I stated before, we really want to stay focused on funds from operations. So they're projecting out roughly $4.17 to $4.29 for normalized FFO per share. So I'm going to meet in the middle and just say $4.20. Currently the stock's trading right around $55 a share. We divide that by the $4.20 and we get a 13 multiple of funds from operations, forward funds from operations at 13 times, which to me is, I would say that's not a screaming deal. I would think that it's okay. And when we look at prior history, there's not a lot of growth within their funds from operations. And I don't think any growth is going to come into the future, even if they make some decent acquisitions, because the debt cost is going to be there. So now the question becomes, at what price do we really want to buy Realty Income? That makes a lot of sense, because for me personally, I think between 10 to 11 times actually makes a little bit more sense than paying 13 times. Now, I know that doesn't seem like a big difference, but we're really buying this company for the dividend. And so if we want some sort of capital appreciation, we have to build some safety in our valuations. And where I think the safety comes in valuations is between 10 and 11 times. So we use that same 4.2, we multiply it by 11. And I think a $46 to $50 price makes a little bit more sense here to take on the risk for Realty Income. Number one, you're going to get a higher yield on the dividend. And number two, you're also going to get some sort of capital appreciation, in my opinion, past year 2026. I do think this is a stock you could be sitting on for multiple years until we see that 10-year treasury come down a little bit more and they can start refinancing their debt and getting better interest rates, which then will grow the FFO. So as always, guys, wanted to jump in here, give you guys my thoughts on Realty Income. Overall, it's a great company. I have nothing bad to say, but kind of wanted to just bring to light some of the opportunities and or reasons why we're not seeing a lot of movement in the stock after hours. I do think this is probably a stock that's going to trade between $50 and $60. And ideally, I think it makes more sense to enter this stock around the $45 to $50 range. As always, guys, really appreciate your time and we will see you in the next one.